This is Lecture 2, Financial Statement Analysis. Take a look at the chart in the next slide. We have seen it in the last lecture, and we will see it many more times during this semester. So this is telling you that this is one of the most essential concepts for this course. This chart is about valuation. The formula in the middle says the value of an asset is the total present value of all its future cash flows this asset can generate, discounted by the cost of capital, VAC. Today's lecture is about the upper part of this chart, the company's ability to generate free cash flows. In this lecture, we cover Chapter 2 and Chapter 3 of the Brigham and Acker textbook. After studying these two chapters, please also read the Financial Detective Case from the BES casebook. Major topics in this lecture include analyzing basic financial statements, including the income statement, the balance sheet, the statement of cash flows, estimating free cash flows, measuring firm performance by the EVA and MVA, the economic value added and market value added, financial ratio analysis, DuPont analysis, and we'll also have a discussion about the limitations of ratio analysis. We'll base our introduction on the mini case provided at the end of Chapter 2 and Chapter 3. First, let's take a look at the financial information we have, including the income statement, balance sheet, statement of cash flows, and some other data for the company for selected number of years. Here you have the income statement for this company for 2015 and 2016. On this slide, we have part of the balance sheet data for 2015 and 2016. This part is the asset part. Now we have the liability plus equity part of the balance sheet for 2015 and 2016. As you can see that, of course, total asset should be balanced with the total liability plus equity for both years. On this slide, we have part of the statement of cash flows for this company as of 2016. This is actually the top part of the statement of cash flows, which is the cash flows from operating activities. Then we have the rest of the statement of cash flows. We have cash flows from investing activities and cash flows from financing activities. Now let's see what we can read out of these financial statements. First question is, what happened to sales and net income? If we look at the income statement, we can see that as of 2016, sales revenue increased by over 2.4 million. So that sounds pretty good. However, costs shot up by more than sales. So then, as a result, the net income was negative. We can also see that the company received a tax refund instead of paying tax, since it paid taxes of more than $63,000 during the past 2 years. Then, if we look at the balance sheet, we can see that as of 2016, on the asset side, net fixed asset almost tripled in size. Accounts receivables and inventories, they almost doubled. And cash and short-term investment actually fell. On the liabilities plus equity side, current liabilities increased as creditors and suppliers financed part of the expansion. Long-term debt increased to help finance the expansion, and the company did not issue any new stocks. Retained earnings fell, and that is due to the years of negative net income and dividend payments. Let's also take a look at the statement of cash flows. If we take a look at all the parts included in the statement of cash flows, we see the net cash provided by operating activities and net cash used to acquire fixed asset or say involved in the investing activities. And then we see the net cash provided or used by financing activities. These three parts all together, they add up to the net change in cash, which is the negative 1,718 you see here. We can also see from the balance sheet that the balance of cash at the beginning of the year, or say beginning of 2016, is 9,000. So 9,000 plus the net change in cash, which is a negative 1,718, that gives us the cash balance at the end of 2016, which is 7,282. A few comments here. First, the net cash flow from operations is a negative $503,000. That is because of the negative net income and also increases in working capital. The company spent around $700,000 on fixed assets. So that's the amount used to acquire the fixed asset, part of the investing activities. Also, the company borrowed heavily and sold some short-term investment to meet its cash requirements. Even after all these borrowing and selling of short-term investments, the cash account fell by 1,718. So far, you have seen that we looked at the financial statement prepared and reported by the company, and we try to tell a story about what has been going on in this company. To figure out what's going on, you will have to look at all these accounts as well as the changes in the accounts and try to find a reasonable explanation about what happened or say why the changes. We can also use the financial statement data for more analysis. First, we try to estimate the free cash flows generated by the company. We say free cash flow is the amount of cash available from operations for distribution to all investors, including the company's stockholders and debt holders, after making the necessary investment to support the company's operations. A company's value depends on the amount of free cash flow it can generate in the future. What can the company do with the free cash flows? They can use free cash flows in the following 5 ways. First, they can use the money to pay interest on debt. They can also use it to pay back principal on debt. So these two are paid toward debt holders. They can also use free cash flows to pay dividend or use the free cash flows to buy back stocks or say to repurchase stocks. And these two are paid back to shareholders. In addition, the company can use free cash flow to buy non-operating assets such as the marketable securities or make investment in other companies. The flowchart in the next slide describes the process of estimating free cash flows based on the information from balance sheet and income statement. It is followed by a detailed explanation about the calculation process. This is a flowchart to explain how to estimate the free cash flows in 5 easy steps. So you see step 1, 2, 3, 4, and 5 here. In the next few slides, we'll explain these steps one by one. In step 1, we calculate the net operating profit after tax. This is also called the NOPAT. The NOPAT is a company's after-tax operating profit for all investors, including shareholders and debt holders. For companies with no debt and therefore no interest expense, the NOPAT is equal to net income. In other words, NOPAT represents the company's operating profit that would accrue to shareholders after taxes if the company had no debts. Let's use the income statement data to calculate the NOPAT. The formula is NOPAT equals to EBIT, which is earning before interest and tax, multiplied by 1 minus the tax rate. For 2016, EBIT is 17,440. That number you can find it from the income statement. So 17,440 multiplied by 1 minus 40%. Well, 40% is the tax rate. You get a result of 10,464. So that is the NOPAT as of 2016. If we follow the same formula and we find the EBIT from 2015's income statement, we can calculate the NOPAT for 2015, and the result should be about 125,460. In step 2, we calculate the net operating working capital, or say the NOWC. To explain this, let's first say we have the operating current assets, which are the current assets needed to support the company's operations. So the operating current assets would include cash, inventories, and accounts receivables. Short-term investments will be excluded from the operating current assets because they are not part of the operations. Operating current liabilities are the current liabilities resulting as a normal part of operations. So operating current liabilities would include account payables and accruals, or say accrual expenses. Note payables usually are excluded from the operating current liabilities because this is a source of financing, not really a part of operations. The net operating working capital is the difference between the amount of operating current assets and the amount of operating current liabilities. So if we use the information from the balance sheet, for 2016, total operating asset would include all the cash, accounts receivable, and inventories that you can find from 2016's balance sheet. And that number, that total, minus the accrual expense and account payables that you can also find from 2016's balance sheet, the result would be about 1.3 million. That is the net operating working capital as of 2016. If you follow the same formula, calculate the NOWC for 2015, the result should be about $793,800. In step 3, we calculate the total net operating capital, which is also called the operating capital. Total net operating capital would include both short-term capital, which is the NOWC, and long-term capital investment. The formula is operating capital equals to NOWC, net operating working capital, plus the net fixed assets. If we use the NOWC that we just calculated and also the net fixed asset data from the balance sheets, we can add those two together and calculate the operating capital for 2016. So NOWC, as you got from last slide, would be about 1.3 million, and net fixed asset, that is from the balance sheet, that would be about $939,000. So the total is about $2.2 million. And if you follow the same formula and try to calculate the operating capital for 2015, I would suggest you try the practice and check your answer with me, and the answer should be about $1.1 million shown here. So from the previous calculations, you see that the operating capital for 2016 is about 2.2 million, while in 2015 it was about 1.1 million. So this indicates that during the year of 2016, the company has made some additional investment into its operating capital. Therefore, we have the net investment in operating capital during 2016 as the result of operating capital in 2016 minus the operating capital in 2015. So we plug in the numbers and we get the result as about $1.1 million here. Finally, we calculate the free cash flows for 2016. Free cash flows for 2016 is calculated as the NOPAT for 2016 minus the net investment in operating capital during the year of 2016. Since the company only made about $10,000 as NOPAT in 2016, it made about $1.1 million investment in operating capital. The free cash flow result turned out to be a negative $1.1 million. How do you suppose investors would react to this negative free cash flow? Negative free cash flow is not necessarily bad. If free cash flow is negative for 1 year or two, it would indicate that the company is making large investment or is expanding. However, persistent negative free cash flows over a long term could be an alarming sign. In the last couple of slides, we introduced the process to calculate free cash flows for a company based on the balance sheet and income statement data. Free cash flow is one of the most essential topics in corporate finance. However, the calculation of free cash flow can be pretty complicated because of the multiple steps involved. So to get familiar with the process of estimating the free cash flows, I would recommend you to use the question number 15 from the Brigham and Eckert book for practice. Excel template for this question is posted on D2L under the folder Excel Models. So if you want to use the Excel templates to calculate the free cash flow, to practice with the calculation of free cash flows, take a look at that file. We can also compute some other measures to see if the company is actually creating value for its investors. These measures include ROIC, which is the return on invested capital, the EVA, which is the economic value added, and MVA, which is the market value added. For this company, what level of return does it get out of the capital it invests? We can use the return on invested capital formula to measure that. So the return on invested capital simply is the NOPAT divided by operating capital. NOPAT, as we calculated, is $10,000, around $10,000. Operating capital for 2016, we calculated to be about 2.2 million. So the ratio is about 0.5%. If we do the same thing for 2015, we get 11%. Then think about it. If the company's WACC, which is the weighted average cost of capital, is 10%, does the growth of the company in 2016 add value to the company? Or say all those investments, does it add value for this company? The answer is actually no, because the return is only 0.5%, which is lower than the cost, the WACC, of 10%. Investors actually did not get the return that they would require. We can also calculate the economic value added, or say the EVA. EVA is the value created by the company in excess of the required return by the investors. In other words, EVA is a profit earned by the company less the cost of financing the company's capital. Now, on the dollar sense, the profit earned by the company is the NOPAT, and the dollar cost of financing is the percentage cost, or say the WACC, multiplied by the amount of capital it financed. So if we assume a 10% WACC, or say 10% cost of capital for both 2015 and 2016, then we can see that for 2016, the NOPAT is 10,000, around 10,000, and invested capital was calculated to be 2.2 million. So the EVA for 2016 turned out to be a negative $200,000. And that number for 2015, if you do your own calculation, you should get the result that it's around $11,000. The market value added, MVA, is the difference between the current market value of a firm and the capital contributed by its investors. So MVA is calculated as the market value of the firm minus the book value of the firm. Market value of the firm is the total market value of its common equity and the market value of its debt. So it's calculated as the number of shares outstanding of its stocks multiplied by the stock price per share plus the market value of its debt. Book value of the firm is the total book value of its common equity and the book value of its debt. And usually we assume that the market value of a company's debt is pretty close to the book value of the debt. Then MVA is simplified to market value of the equity minus the book value of equity. Market value of equity for 2016 is $6 per share multiplied by 100,000 shares, so that's a total of $600,000. Book value of the equity for 2016 can be found from 2016's balance sheet, so that's $557,000. So therefore, MVA, market value added for 2016, is the market value minus the book value of equity, which turns out to be about $42,000. If you calculate the MVA following the same formula for 2015, the market value added for 2015 should be about $186,000 as shown here.